Canada has escalated what many are now calling an economic war, and global markets are bracing for a historic shockwave. In a move that could reshape trade relationships and disrupt supply chains worldwide, Ottawa has signaled it is ready to take aggressive economic action amid rising tensions. Investors are watching, governments are calculating, and markets are reacting. Tonight, we break down what happened, why it matters, and what could come next. Economic war doesn't involve tanks or missiles. It involves tariffs, trade restrictions, export controls, sanctions, and strategic economic pressure. When countries escalate economically, they target industries, markets, and supply chains. And Canada, one of the world's top trading nations, holds significant leverage. From energy exports to critical minerals, agricultural goods, and manufacturing supply chains, Canada plays a crucial role in North American and global trade. If Ottawa tightens policies, the ripple effects can move fast. In 2025, U.S. tariffs triggered a cycle of retaliation, lawsuits, and rising uncertainty across borders. After emergency tariffs were struck down, Washington announced a new 10% global tariff with threats of steeper measures. Ottawa responded with strategic countermeasures to defend industries and signal resolve. The toll is real: higher costs for households and pressure on jobs and investment. Now, what does this mean for markets? Why Canada holds leverage and the scenarios ahead? Let's break it down. Financial markets thrive on stability. But when geopolitical uncertainty rises, volatility follows. Already, analysts are warning of currency fluctuations, energy price swings, investor uncertainty, and supply chain disruptions. If trade tensions escalate, businesses face higher costs, and consumers may see rising prices. Global markets are interconnected. A decision in Ottawa doesn't stay in Ottawa. It echoes across Wall Street, European exchanges, and Asian hubs. Volatility touches portfolios, paychecks, and everyday budgets. Next, why Canada holds leverage. Canada is not a minor player. Its leverage comes from critical energy, food, minerals, and integrated manufacturing. Energy markets are sensitive. Tightened supply and prices can spike, affecting households, transport, and factories. Canada is a major exporter of wheat and agricultural products, key to food costs. Rare minerals feed batteries and electronics, core to the clean tech economy. Auto parts cross the border multiple times. Disruption halts lines and hits jobs on both sides. The US and Canada share one of the world's largest trade relationships. Billions move daily. Escalation risks collateral damage, jobs, investment, and growth. Is this strategic negotiation pressure or the start of a prolonged economic standoff? The world already faces inflation concerns, supply chain vulnerabilities, and geopolitical instability. A G7 escalation could slow trade growth, trigger retaliation, increase commodity volatility, and unsettle multinationals. Emerging markets are especially vulnerable if prices surge or supply chains fragment. The shockwave would not be contained to North America. There are several possible scenarios. Diplomatic negotiations reduce tensions. Legal challenges proceed. Markets stabilize as clarity emerges. Both sides escalate with retaliatory measures, raising costs and breaking supply chains. A frozen conflict forces businesses and consumers to adapt to higher, stickier costs. Canada accelerates diversification, rebuilding flows with other partners. Much depends on political calculations. Investors seek signals, not just statements. Pay attention to official guidance, expect volatility, but remember Canada's strong foundations. Is this a temporary trade clash or a historic turning point in global alignment? Economic wars are unpredictable. They test alliances, markets, and political leadership. For now, global markets remain on edge. The next move will tell us whether this shockwave fades or grows into something larger.